G'day listeners. Today our team are going to present on how the invention of cancer cure could affect the financial market. Our team assumed the cure for cancer was developed by a non-profit organization, which dedicated to make the technology open copyright and royalty-free. This ensures no company can monopolize the technology or dominate the market. The treatment involves a drug that kills cancer cells, eliminating the needs for machine-operated treatments. In the pharmaceutical realm, firms like Pfizer could witness a rise in stock price, driven by anticipated revenue from ancillary treatments and supportive care. Thus, the demand for the cancer cure product will skyrocket, propelling the business cycle into a startup stage as new technologies and treatments emerge in response. On the flip side, the biotech industries like CSL Limited might transition towards a decline stage in its business cycle. With the efforts of new cures, we might see a decreased demand for cancer-related equipment, leading to a potential dip in sales for companies like them. To stay ahead of these challenges, it's imperative for CSL to strategize proactively. One of the viable options might be for them to pivot more into the pharmaceutical domain, ensuring they maintain their market relevance and position. Now, I would like to hand over to Will for a further in-depth analysis.
The risk-free rates for the United States and Australia are relatively high due to high inflation, rising interest rates, and a volatile stock market. The higher risk-free rates are reflected in the current estimated WACC for both of the companies. With that in mind, we recommend a buy for Pfizer and a sell for CSL Limited. To start off, Pfizer has a current stock price of $34.25, and its enterprise value is standing at $211.95 billion, with a WACC of 11.19%. After the shock, the share price surged to 230.35, reflecting an increase of 580%, and the EV increased significantly to 1.32 trillion, with a reduced WACC of 6.69%, as investors are now willing to take on less risk when investing in Pfizer. On the flip side, CSL Limited's share price dropped to $72.51, reflecting a decrease of 56%, with the EV decreasing to 1.431 billion and a higher WACC of 9.23%. The decrease in share price is likely due to potential disruption of CSL's existing cancer treatments and sales of cancer treating equipment. I will now pass my time on to Blake, who will be delving in depth about Pfizer.
Thank you, Will. We move on to the first company that we have valued, and that is Pfizer. And given the market shock that we have provided, it is quite obvious that Pfizer is our buy recommendation. We have analyzed this company based on three graphs, the first of which is a revenue component. Here, we can see that sales has increased exponentially, and with it, net income. Moreover, we assume that certain efficiencies that has come about due to the production and distribution of the COVID-19 vaccine has provided a standard cost of goods sold due to their expertise in that area. Certainly, now we move on to the free cash flow component graph. Here, total free cash flow has increased significantly due to obvious reasons. Moreover, the depreciation and amortization has remained stable because we assume that all the equipment necessary would have already been bought by Pfizer due to the COVID-19 vaccine. And finally, the DuPont analysis provides us that profit margin is the greatest contributor to ROE of Pfizer. And with that, I'd like to hand over the presentation to my dear friend, Ken.
Thank you, Blake. Now for the sell recommendation. This shock may divert both public and private funding away from CSL. Their revenue streams come from two main divisions. First, the Virus division, which is one of the largest influenza vaccine companies in the world. Due to this characteristic, they are immune from this shock. Second, and most importantly, the CSL Behring division. Last year alone, they contributed 13 billion Australian dollars to the total of 19.98 billion dollars of revenue to CSL. They're involved in the developing, manufacturing, and marketing of therapies made from human plasma. These plasma are used to treat medical conditions such as cancer. Now, with the cancer cure, these services won't be necessary. Therefore, CSL Behring won't be making big earnings to CSL Limited. The drop in sales will ultimately track down the revenue, which are shown in this graph. With the withdrawal of public and private funding, CSL has to invest using their own money. And that's why we saw a huge jump in capital expenditures. And that explains the opposite movement of the firm free cash flow. Let's look at our DuPont analysis. It suggests that return on equities are significantly affected by the decline in asset turnover ratio. Now that's a wrap for our presentation. Thank you for listening.